Have you ever wondered why the stock market can rise or fall overnight, or why prices at your local grocery store seem to change so frequently? Imagine if you could predict these shifts. What if you could understand the forces driving the financial markets and the economy so well that you could make smarter, more informed financial decisions? Well, you're in the right place. Today, we're going to dive deep into the world of financial markets and the economy, unraveling the mysteries behind economic cycles, inflation, central banks, and the tools you can use to protect and grow your wealth. Stay tuned. Subscriber request. But before we get started, if you're new to the channel, don't forget to hit that subscribe button. We're striving to hit 1,000 subscribers, and your support means the world to us. We're building a community of smart investors who can take control of their financial future, and you don't want to miss any of our insights. Let's dive into this important topic. Understanding financial markets. Financial markets are the backbone of any economy. They are places where buyers and sellers come together to exchange financial assets, such as stocks, bonds, currencies, and commodities. The stock market, for instance, provides businesses with capital by selling shares to the public, while also giving investors a chance to own a piece of those companies and share in their success. The function of financial markets. At the heart of financial markets is the concept of capital allocation. Companies need capital to expand, and they turn to financial markets to get it. Investors, on the other hand, are looking for opportunities to grow their wealth, and financial markets allow them to do this by buying and selling assets. The value of these assets is driven by supply and demand, and by economic and geopolitical events that influence market sentiment. For example, when the economy is doing well, businesses thrive, and so do their stock prices. However, during economic downturns, investors tend to pull their money out of risky assets like stocks and move towards safer assets like bonds or gold. The stock market, therefore, serves as a barometer for the economy. If the stock market is rising, people feel confident about the economy. If it's falling, there's often fear of an economic slowdown or recession. Types of financial markets. There are several types of financial markets, but the three most common ones are stock markets, where shares of companies are bought and sold; bond markets, where investors buy and sell government and corporate debt; commodity markets, where raw materials like oil, gold, and agricultural products are traded. Each of these markets plays a vital role in determining the overall health of an economy, and understanding how they work is critical to making informed investment decisions. Central banks and monetary policy. Central banks, like the Federal Reserve in the United States, play an enormous role in shaping the financial landscape. They are responsible for managing the country's money supply and influencing interest rates to keep the economy stable. The Federal Reserve, for example, sets key interest rates like the federal funds rate, which affects everything from mortgage rates to the cost of borrowing for businesses. The role of central banks. Central banks have several tools at their disposal, but their main objective is to keep inflation in check and ensure that there is enough economic growth to maintain full employment. They do this through monetary policy, which includes actions such as changing interest rates or buying and selling government securities. When the economy is growing too fast and inflation starts to rise, central banks may raise interest rates to make borrowing more expensive, which cools down demand and keeps prices stable. On the flip side, if the economy is sluggish, central banks can lower interest rates to encourage borrowing and investment, which stimulates economic activity. The relationship between central banks and financial markets. These decisions have a direct impact on financial markets. For example, when the Federal Reserve raises interest rates, bond prices often fall because the yield on new bonds becomes more attractive. Similarly, when interest rates are low, stocks tend to perform better because borrowing is cheaper, encouraging business expansion and consumer spending. Stock markets and the economy. Now, let's take a closer look at the stock market, one of the most important segments of financial markets. The stock market allows investors to buy and sell shares of publicly traded companies, and it plays a critical role in the economy. Stock market trends. Historically, the stock market has been a great way to build wealth. When companies perform well, their stock prices rise, and investors see returns on their investments. However, the stock market is not without risks. Economic downturns, recessions, and global crises can cause stock prices to plummet. But stock market performance is often linked to economic growth. For instance, during periods of expansion, corporate earnings rise, consumer confidence increases, and companies hire more workers. This, in turn, boosts stock prices as investors anticipate higher profits for these companies. Understanding market indices. You've probably heard terms like the Dow Jones Industrial Average or the S&P 500. These are stock market indices that track the performance of a group of stocks. The S&P 500, for example, includes the 500 largest publicly traded companies in the U.S., and it serves as a key indicator of how well the broader market is performing. Tracking these indices helps investors gauge the overall direction of the economy. Bonds and interest rates. Bonds are another crucial aspect of financial markets. When you buy a bond, you're essentially lending money to a company or the government in exchange for periodic interest payments and the return of your principal at maturity. The bond market. The bond market plays a pivotal role in the economy. It allows governments and companies to raise capital for growth or projects. Bonds tend to be more stable than stocks, which makes them an attractive option for investors seeking safety during times of economic uncertainty. The bond yield relationship. There is a direct relationship between bond prices and interest rates. When interest rates rise, bond prices fall because new bonds are issued with higher yields, making older bonds less attractive. Conversely, when interest rates fall, existing bonds become more valuable because their fixed interest payments are higher than those offered by new bonds. The economy, understanding cycles and recession. Understanding the economic cycle is essential to navigating the financial markets. The economy goes through natural cycles of growth and recession, which are influenced by many factors such as consumer spending, business investment, and government policies. Economic cycles. During times of economic growth, GDP increases, businesses expand, and people are employed. This period of prosperity usually lasts for several years, but eventually the economy slows down and enters a recession. During a recession, businesses cut back on spending, unemployment rises, and economic output shrinks. These cycles are natural, and they repeat every few years. Indicators of economic health. There are several key indicators that can help us understand where we are in the economic cycle. These include things like unemployment rates, consumer confidence, GDP growth, and inflation. Keeping an eye on these indicators can give investors an early warning sign of economic shifts. Commodities and global markets. Commodities are another essential aspect of the global financial market. These include raw materials like oil, gold, silver, and agricultural products. Commodities are often used as a hedge against inflation and can be a great way to diversify an investment portfolio. Commodities as investment vehicles. Gold, for example, is often seen as a safe haven during times of economic uncertainty. When the value of paper currency decreases, people turn to gold as a store of value. Similarly, oil prices often rise during times of inflation because the cost of oil impacts the price of nearly every product. Global markets and geopolitics. Financial markets are heavily influenced by global events. Whether it's a trade war, a geopolitical crisis, or global pandemics, these events can send shockwaves through the markets. As investors, it's essential to understand how global factors affect local markets and how to adjust your portfolio to manage this risk. Navigating financial markets, strategies for investors. Finally, let's discuss how you can navigate the financial markets and make the most out of these opportunities. Diversification. The most effective strategy for managing risk is diversification. By spreading your investments across different asset classes, stocks, bonds, commodities, real estate, you reduce the risk of any one asset underperforming. The goal is to create a balanced portfolio that can weather any economic storm. Staying informed and long-term investing. Staying informed about the economy, financial markets, and current events is key to making smarter investment decisions. Whether it's through following market news, reading economic reports, or working with a financial advisor, keeping yourself educated is the best way to navigate these markets. The world of financial markets and the economy is vast, interconnected, and ever-changing. From understanding how the stock market works to keeping up with central bank policies, the knowledge you gain today will empower you to make better financial decisions and safeguard your wealth for the future. Thanks for joining me on this journey. Don't forget to subscribe to the channel and leave a comment below with your thoughts on navigating financial markets. I look forward to building a community of smart investors who are ready to take control of their financial futures.